Hey, my name is Jack Nicholson. Welcome to my YouTube channel. Interest rates are up, interest rates are down. I'm going to talk about who's cutting rates, who's increasing rates. On average, mortgage rates are going up. I'm going to talk about why that's actually happening, because the Bank of England cut rates this month, didn't they? Or in the last month. So why are we getting the opposite happening? Well, we're going to talk about all of that and much more in this video. If you're new around here and you haven't done already, this is the place where you're going to get all the latest property news, interest rate news, house price news, investing in property news, and much more. So subscribe to the channel over there and hit that bell notification. We're nearly at 50,000 subscribers now, and let's get some more views on this video. Your part is simple. All we need to do is smash like, tickle like, do something to that like button. That really helps with the YouTube algorithm, and that's really helped the channel grow. So thanks to everybody that does that. So what's going on? Well, it doesn't make sense really at the moment, does it? The Bank of England's cutting rates, but lenders are increasing rates. And that's down to something called the swap rates. So the SONIA swap rate is actually increased recently, and the SONIA swap rate is the rate that your bank borrows from. So maybe you borrow from HSBC, Nationwide, Santander, Barclays. It doesn't really matter who you borrow from. They borrow from a bigger bank, and the rate that they get theirs based off is not really off the Bank of England. It's more of a projection on where the Bank of England rate is going to go. And the problem is that we've got at the moment that the Bank of England was expected to cut rates, but then inflation has come sneaking back. Inflation is back at 3.8%. It's likely that it's going to go above 4% in the next few months. And that really isn't helping, because the Bank of England's job is to give maximum employment and also keep inflation around 2%. And obviously 4% is a long way from 2%. It's twice their target. So at the moment, they've got a real problem because unemployment's going up, but also inflation's going up. You'd call that stagflation. And that's a real problem for the Bank of England. So they decided to cut in August, even knowing that the inflation was going to rise. And now they've got their dilemma. Do they cut again, or do they wait and see what happens? Now, unemployment in the UK is not looking great. And you've got a budget that's coming up in November, I think it's been pushed to now. And we're not expecting good things in that. You're going to get tax rises. That's going to stop people spending. They're going to have less disposable income. So businesses are going to get hit. And I think it's going to be very hard to avoid a recession. I don't quite know how we've managed to just about skip that recession over the last few years. And so that's going to slow down the economy. Labour already did a lot to slow down the economy. They increased the national insurance. They increased the minimum wage. They increased business rates. They did nothing to help with the energy costs going up. All of those things meant businesses suffer. Those businesses are recruiting less, and in fact, they're laying people off. And that's causing unemployment to go up. I wouldn't be surprised if we hit more than 5% unemployment at some point in the near future. And so because of that, the swap rate, the rate that your bank borrows at, has been a little volatile. It was going down prior to the August meeting with the Bank of England because the expectation was that we were going to get cuts. And now it's been creeping back up because we're not certain when we're going to get the next cuts. And that means that your bank is now paying more money to borrow, and that means they're passing that on to you. So what are average rates and where are they at the moment? Well, the 2-year rate across all lenders, this data is from Uswitch. The 2-year rate has gone from 4.7% to 4.74%. That means that's the average of all the lenders that are lending 2-year mortgages on Uswitch, right? So the average has gone up by 0.04%. So that's creeping up. That's going on in the wrong direction. What about the 5-year deal? So the 5-year deal is the same. That stands at 4.94%. So that's all lenders, again, the average rate. Now, you can get better rates than that, but that's the average. And so that means that lenders have been increasing the cost of their 2-year deal, doesn't it? So if we've gone from 4.7 to 4.74. There's some lenders in there, quite a few of them, that would have been increasing their rates. But one lender has bucked the trend, and that's HSBC. So what are they doing at the moment? So HSBC are cutting some of their rates, and they're cutting their 5-year deal. Notice, it's the 5-year deal that's sticking with all lenders, but HSBC have cut it. They've held their 2-year rate, but the 5-year deal is going down slightly. So what's it doing? Well, it's gone from 3.94% down to 3.9%. And that is on 60% loan to value with £999 in fees. So it's not a bad deal. That is probably one of the best deals. Now, if you're an HSBC Premier customer, that's where you pay like £10 a month and you get your travel insurance and all that sort of stuff included. HSBC Premier customers can get a slightly better rate as well. I think they're getting around 3.85%. So a smidge cheaper on mortgage rates with those guys as well. And that's positive stuff. And that's what we want to see, is the fact that this stuff is moving in the right direction. Now, why have they done this when everyone else is increasing their rates at the moment? Purely down to the fact that the market is slow. You see, the first quarter, I've said it many times, it was busy, wasn't it? January, February, March, lots of people were trying to get those transactions done prior to that stamp duty increase. There was 500,000 deals done in that time, but the next 9 months, the rest of 2025, we're only expecting a 500,000 property sales as well. So that means we are dropping significantly the volume of deals. And so HSBC have looked at this and said, look, it's costing us more money to borrow, but we want more market share. We need to get some deals over the line. And that's why they've done this deal on the 60% loan to value. So they're taking the safe money here. They're taking the ones with decent equity. They're not taking high risk 100% mortgages at this rate. They're taking the pretty much dead cert deals that you know the market isn't going to drop 40%. You're pretty safe if you take those on. And if someone's got a 60% loan to value, the affordability of the monthly payments is more likely that they can keep up with those as well. So you've got a reduced risk of repossession. And if you did get a repossession, you're likely to recoup your money. That's what they're doing here. So this could happen with more lenders, but likewise, we also could see more lenders increase rates as well. It is a volatile time at the moment, and we just need a little bit more jobs data and stuff like that, and a bit more of an idea on where we're definitely going with this inflation before the Bank of England will really make any more moves. I think you're going to see a few months where they just hold interest rates now. Let me know if you see any lenders that are cutting rates. I want to share them with everyone and on the channel. And before you go, I want to let you know about a special deal. We brought it back. We're doing the fundamentals of property investing for just £20. That will help you find properties below market value. If you're an existing landlord, we'll teach you how to high cash flow those strategies. Or if you just want to know how to get into the market and make decent money. Normal buy-to-let is very hard at the moment. So we'll talk about HMOs, serviced accommodation, all of that stuff and much, much more. It's £20. It's a one-time fee, no subscription. All you need to do is click on the link in the description below, go and check it out and get invested and learn all the strategies in there. Do make sure you like this video and check out all the other content as well on the channel, including this video right here.